Hello investors, this is Stuart Cruz with Cruz Asset Management's video chart of the day. We've been talking a lot about the economy, post-lockdown, current coronavirus environment, and we're seeing a bifurcation of a lot of areas. Some are quite strong, like the housing market, the retail market, quite strong. The stock market is on fire, and then some sectors and indicators are quite weak, like unemployment is very weak. Consumer sentiment, which I spoke about earlier this week, is also weak. And now let's talk about U.S. energy consumption, which is an indicator of how much manufacturing is going on, how much productivity is happening in the economy. So right now, here I have a 5-year chart of the U.S. Primary energy consumption, and this is 5.2 quadrillion with a Q BTUs for April. That's for those of you who don't know what a quadrillion is, it's 1,000 trillions or a million billions. So that's a quadrillion. 6.5 quadrillion BTUs. And what we're basically saying is this is a change of 16% down from last month and 14% from a year ago. And you can see this is quite cyclical. Now I'm going to switch this to a chart that's let's look at a 10-year chart so you can kind of see the pattern a little bit more clearly. And you can see this is very seasonal. So we spike in the winter as energy consumption goes up, as people need more heating and whatnot. And then we also spike in the summer as people need more cooling for energy for cooling. So you have a bigger spike in the winter, a smaller spike in the summer, winter, summer, winter, summer, and this goes on. So the average BTUs is a little bit around, looks like 8.15 quadrillion BTUs, and here we are down at 6.5. So that's a considerable drop off. We haven't seen this even in the lowest energy consumption periods, which this was April, kind of mid-quarter of 2012. I have to go back, if I look at this max chart, I have to go back all the way to here, to 1989, September of 89, in order to get a lower number of energy consumption. That's 30 years. We haven't seen this level for quite some time. That's a pretty big drop off in energy consumption. So that's not very good indicator for the economy and how much energy is being used. Now, if we look at crude oil production, I'm going to put this on the chart. We've been increasing our crude oil production for the last decade. But of course, you see a drop off as our consumption's dropped off. And I'm not sure if you're aware of this, but a couple of months ago, back in May, we had so much excess oil that we couldn't even find a place to store it. So the spot crude prices actually went negative, meaning people were going to pay $35 a barrel for you to take the oil off their hands. Usually you have to pay to buy the oil. You were getting paid to take the oil because there was no storage available. So you see a big drop off of the oil productivity right here. And if I also put on this crude prices, let me clean up this market here. You see the prices were hovering around 90, it looks like $95 a barrel. And then 5 years ago, they kind of took a leg down. Let's move this back to a 5-year chart. So they took a leg down, and I'm going to split these panels so you can see an average of the spot oil prices, which is around $50 a barrel, and now we're trading at about $40 a barrel, so more than 20% off the average. So it's not a very good indicator of where the economy is right now, especially with the high unemployment. Now, what they'll say is the cure for low energy prices is low energy prices, and vice versa. The cure for high energy prices is high energy prices. What that basically means is if energy prices are low and they hit a big time low number down here, as I indicated back in April and in May, if you look at low energy prices, people will then start consuming more energy because the production costs generally are 50% comprised of energy costs. So if energy costs are low, people can afford to produce more goods and services. They can afford to produce them more cheaply. That's somewhat deflationary, and that helps actually spur the economic activity. So traditionally, when energy prices are lower than they were 6 months ago, that is good for the economy 6 to 9 months in the future. And traditionally, when energy prices are higher than what they were 6 to 9 months ago, then that's bad 6 to 9 months. So we have a very low, relatively low energy price, so that could be good for further economic development, but keeping in mind that we are well off of our averages on the energy consumption. So again, we're going to keep abreast of these competing economic indicators, because some are showing things are quite strong, like the housing market and the tech sector, and some are showing that the market is quite weak, like unemployment and consumer sentiment, and energy consumption is also kind of a check mark in the weak box. So we'll keep an eye on it. We'll continue to watch these markets move, and we'll continue to invest with the odds in your favor.